I'm super excited for our guest today. We've got an awesome panel. Looks like we got Shuri from LA. Sharif, awesome. Thanks. Good to see you, brother. Um, awesome. Great. Go and keep that chat going there. You should be able to chat with anybody in the group. So feel free to, if you want to chat, kind of see who's here. Again, we should have a good crowd today. And this will be recorded. So if you do miss out on part of it, we will be able to share it with you later. And also, we will do some Q&A at the end. So really excited to give a quick introduction for myself and this event, and then we'll welcome up our panelists. Very excited to be able to have them here today. This is going to be another awesome conversation. We do this every month, so we do a Bronson Equity Monthly panel. We typically talk about real estate, multifamily, and we have one next month about tax strategy on December 17th. I'll give you some update on that date in a little bit, but give a quick little intro for myself. So my name is Bronson Hill, CEO of Bronson Equity. We've got about 2,500 multifamily units. We've also got other businesses, car washes, oil and gas, so the sorts of venture capital kind of things. Also doing some private equity purchases and cash flowing businesses. And so this is part of what we do. Is we do a lot of education for folks. Have a podcast called The Mailbox Money Show. Wrote this book behind me here. It's become an Amazon bestseller. Really excited you're here. So we're going to get into things that are really important about the shocking truth about the future of multifamily. There's things that you may know. There's things you may not know. But there's some things that are very shocking about it, and we're going to get into things that I find shocking about it, Stephen Pesavento and Vina Jetty find really shocking about it. So I'm going to give a quick intro. I'm going to welcome our panelists up. I'm going to make sure Vina is here. I know I didn't see her before the call, but hopefully she is here. I do not see her. So initially it's going to be you and me, Stephen, and we may see if I can find, there's our panelists there. Okay, awesome. Okay, great. All right, I'm going to move you to the webinar and we're going to get going here. So let's get ready to jump in. Okay, so you just got to accept that. There we go. Perfect. And then we'll keep an eye out for Vina. If anybody sees Vina, pop into the chat there around, let me know, and I will welcome her up. Looks like I saw Janet is here from Dallas, or Janice, excuse me. Welcome, Janice. And I've got a bunch of friends in the room, so really excited to see you all. So awesome. Well, Stephen, welcome. Stephen is the CEO of Von Finch Capital, and he runs the Investor Mindset podcast. And I think this is awesome when we talk anything about investing. A lot of investing, I was telling a friend earlier, is mindset, right? Being fearful when others are greedy and being greedy when others are fearful. And there's a lot of fear in the market today, but there's also incredible opportunity I'm super excited about. So Stephen, why don't you just take a minute or two and just introduce yourself and welcome today. Excited to have a conversation about multifamily investing and what's happening in that world.
Yeah, Bronson, thanks for having me here. Excited to be here. I'm based out of Denver, born in Minneapolis, oldest of four kids, started my career in management consulting, moved into tech and then into real estate and have, bought and flipped over 200 houses, been a part of buying 20, almost 30 individual multifamily properties. Von Finch Capital has over $550 million of real estate that we've bought, owned, and managed on our platform. And we've got a really cool way that we operate. So happy to talk about any of that. But, it's an interesting market and it's a funny time because a lot of people are weary, and especially after the rate hikes of 2022, a lot of people kind of pulled out of the market. They were sitting on the fence. And I'll be honest, some of the best deals I ever bought, I bought in 2023. While everyone was telling me there's no deals on the market, there was definitely some amazing deals in the market.
Yeah, and that's really, I think, one of the amazing things about investing, right? And this is something Warren Buffett talks about. He's like when you're doing great investing, I mean, he talks about it this way. He's like, it's like finding a dollar bill that you only paid 40 cents for, or finding a $20 bill on the ground. Somebody who doesn't really is not looking will say, well, if it's a $20 bill, it wouldn't be on the ground. Or if it was really a dollar, you wouldn't be able to buy it for 40 cents, or you wouldn't be able to, and those are obviously very significant discounts. But yeah, you're right. I mean, it's being available when other people are not looking for it. So I think that's a huge thing. So awesome, man. Well, let's kind of jump right into it. And let's kind of get into the nitty gritty. We will take some questions here at the end. So again, thank you to everybody who's here. We're really looking forward to having a conversation and really being able to jump into it. And I just have a tremendous amount of respect for Stephen, for his work, for what he does, for his business and all of that. And so it's something that we've been friends for quite a while and collaborated on some things, which is awesome. So Let's talk. We just are getting through an election, right? So President Trump will start in January, and regardless of whether you fall, wherever you fall on the political spectrum, that has impact for real estate investors. Can you talk, or let's maybe you can share a couple things you think? I don't mean to put you too much on the spot. You know, I'm not a political analyst, but we'll let them know any thoughts you have about that and how that relates to investing.
Well, I think, taking my personal political views out of the conversation, happy to talk about them. But I think what's most important is that there was a massive victory on the Republican side. It was across the board. Republicans won the House, the Senate, and of course the presidency. And they ran on this agenda of bringing things back to America and focusing on solving problems in the US. So I think what's really powerful and important from that message is that if what they talked about doing does come to fruition, there is likely to be a good roar in the US economy. And there's likely to be a good roar in the real estate economy because obviously our president was and is a real estate developer and deeply understands this business and the incentives. And during his previous presidency, we had a phenomenal economy for real estate. Real estate was ripping. We had great tax incentives in place. The Opportunity Zone program was put into place, which led to massive amounts of capital into, gentrifying areas that were once dangerous and not places people wanted to live. A lot of money moved into. And there's absolutely some places where that wasn't used properly. But if I was going to put on a prediction hat, I would say we're going to be in a much better place 4 years from now, as long as from a country standpoint, we're able to get some civility back and we're able to see that 80% of the things people believe, there's agreements and we just need to find common ground on that 20%. But I would predict good things are going to happen in real estate. And, a big part of that is going to come down to what the Fed does. We need at least stability in the interest rate markets for real estate to really be able to do what we need to do. Because when you're locking in fixed rate debt, if it's going to go down 2 or 3 points, people want to wait. If they know that debt is going to stay where it's at, more and more buyers come off the sidelines, more and more sellers are willing to, come to terms on price. And that's something we absolutely need.
Absolutely. The interesting thing too about Trump is that he was the one who really instituted a lot of these tax breaks that we've had, right? The 100% depreciation that lasted for it was like 4 or 5 years, and then it started to phase out. And so now we're at 60% as opposed to 100. Next year we go to 40%. But if this is continued, and it seems like there's Republican control of both the House and the Senate, and so it seems that that could be likely, right? Some extensions of these see more benefits for real estate investors, which can be huge. And so I think there's a lot to like about it. You saw with the markets, they came up quite a bit, which is something that's really interesting to see. Let's kind of talk a little bit about a lot of investors, and we talked about this a little bit before we started. I had an investor recently who had invested like over $1 million in a bunch of deals, and they were all like having challenges, right? And some of it could be operator challenges, some of it could be because of the interest rate, some of it could be because of other reasons. But there's just been some challenges out there, and I think personally, I think it's one of the best times right now to be looking to get back in and to really be looking for deals because I think that we're seeing discounts, sometimes 10, 20, 30% in phenomenally growing markets, right? And we know we've got a shortage of, 2 to 8 million apartment units, depending what, kind of metric you look at. But what is it about, I guess, when it comes to human psychology, why we just tend to want to sell and get out when it's really the time we should be doubling down and getting in?
Well, I think it's super important. I'd love to like kind of go back and forth on this topic for a little bit if
Yeah,
you're comfortable with it. But
let's do it.
I think what's fascinating is everybody knows that when it comes to investing, you want to buy low and you want to sell high. But
Right.
what do people actually do? What is it?
Opposite.
What is the historic trend of what people do?
They panic. They sell panic sell.
They panic
They
and they
buy at
buy
a
high
frenzy.
because they follow everyone into the newest thing and they sell. They see Bitcoin hits 100, they say, "Oh, I should get into Bitcoin now." They missed the wave. Now, I'm not saying that I'm not making a prediction on that particular asset class, but the point being is you want to get into assets when they're low or when there's stability in them. And the irony is for everybody who bought in 2021 and 2022 in the real estate market, you bought at the top of the market. if you made an investment, no matter how experienced that operator was, no matter how junior that operator was, there was a belief at that time that there was still quite a bit of runway left. But it's not until after the Fed raised rates at the highest they've ever raised them in the last 20, almost 30 years, that we realize, looking back, because you only really know where the top and the bottom is after the fact, we now realize that that was the top of the market. And so if you bought at the top of the market, what I found is in talking and interviewing and working with a bunch of investors and operators, a lot of people were saying, hey, well, I bought at the top of the market. I'm going to wait. I'm going to wait to see if I can get in. And they try to time the market. Biggest mistake you can make. Definitely makes sense to wait for a little bit of stability. But the irony is on the other side of that, right now in multifamily, this data is probably 3 or 4 months old, but right now in multifamily, we are down about 35 to 40% in valuations. Transaction volume is down from the peak, and it's about 1/3 of the amount of transaction volume that was happening at the peak and during the stabilized time. So what's interesting about that is you could either say, hey, there's no deals available, and you could sit on the sidelines, or if you went and underwrote each of those deals that traded, there's a handful of those deals that are very large, and they were bought by institutions, and they were probably bought, in my opinion, above where the market's actually trading, because those
Right.
large institutions were sitting on a lot of money. They had to deploy it. That's what their goal is. But most of those deals that traded were from people who had some type of distress. And I personally closed on a handful of deals that were bought at a 30, 40, sometimes even a 50% mark down from where the current appraised value is. And the reason that's true is because a lot of people were not able to get debt. They didn't have the liquidity, and they were in a tough situation. And so even if they weren't forced to sell, they still feel like they missed the mark. They wanted to retire,
Right.
they wanted to get out of the asset. And so the irony is the exact time you want to be getting into investing and buying in the market is you either A, want to buy consistently during ups and downs so you can spread it out, but you absolutely want to be rushing in when there's blood in the streets, even if it's your own blood from your own investments.
Yeah, it is a it's a real counterintuitive thing, right? If you've had a challenge in a deal, and like I said, I talked to a lot of people that have had challenges in real estate deals, particularly multifamily or commercial real estate. But there's learning. There's things we can learn from it. There's also opportunities. In this book, I'm actually going to put it in the chat here. It's an incredible book. It's a little bit of a thick book, but it's probably one of my favorite books on psychology. It's called Thinking Fast and Slow. And one of the biases that you brought up, you talked about all these biases. We think we're completely unbiased, but we have all these biases. And one of them is hindsight bias, right? It's like it becomes very obvious when looking back, like, oh yeah, it was really obvious that maybe I shouldn't have done that deal, or maybe the debt, or based on these facts. But we go with the information we have. We can't always figure out. There's also the sunk cost bias is in there. There's also this other thing, it talks about loss aversion that says, if me, I remember when I have a loss, or if I have something that goes negative, I remember it 2 to 5 times as much as something that goes well. So even it shows like if somebody were to if I were to give you $100, but there's a 50% chance that you lose $50. It's a 50-50 chance. It's actually much more likely that you would get the $100, but most people wouldn't do it, even though it would make sense that if you just repeatedly do that over time, you would accumulate wealth. But again, we have these biases. And so it's really important that we take a look at our assumptions and our biases, and we see why we made the decision that we make. And that's why it's actually really valuable. I heard this about stock investing years ago. Whenever you invest in something, write down your rationale of why you're doing this investment. Right, go through and like write that down or send yourself an email, and then you can go back and check and say, well, these were my assumptions of what the biggest risk was, or this is what happened, or here's why I did this, here's why I liked it, here's where some concerns, and then go back later and say, well, what was my rationale actually correct? And so I think again, I've seen some investors when something doesn't go well, they like to blame someone else and say, oh, this is someone else's fault, or this operator, whatever. Well, it may be, but regardless, what is your learning? Because as long as it's somebody else's responsibility, you're never going to have the learning. Stephen, I know you've done
There's
it. Go ahead. Go ahead, Adam, jump in.
there's like an important thing to recognize within that is that investing with a clear strategy, as long as it's aligned for what's actually happening in the market, it can work phenomenally well. But one of the things people often forget is that when you're playing the game of investing, the rules are constantly changing. So it's like you sit down to play the game of Monopoly and you read the rules and you guys all agree on how we're going to play. But in the market of the world, the rules are changing on a regular basis. There's a new regulation that happens. There's new investment from a government standpoint in this local jurisdiction. There's a company that says, hey, we're going to go and move our factory from this state over to this state. The Fed changes rates. The Fed changes regulations on banks, which impacts how lending happens. The SEC changes regulations that impact how equity moves in and out of the public markets as well as the private markets. All of these things lead to you're essentially playing a different game. And so if we look back in reflection, the game that was being played pre 2021, pre 2022 rate hike was a different game than the game and the rules that are available once rates went up. And so the irony is that all of these investors, all of these operators, all these individuals were very excited about the game that was there, right? And it
Yeah.
was a phenomenal time to be buying real estate. Things were moving up. There was a lot of competition, but there was a lot of money available. Well, all of a sudden, once rates started going up and people got scared and money got tight, now you're playing a completely different game. And so the important thing to remember is that if we're playing the game of investing, there is a risk of loss. There's a risk of total loss. There's a risk of going deeper beyond what your total investment is if you're signing on loans or taking on risk, which most LPs are not. But the reason that's important to understand is that when you're playing the game, you want to be winning more times than you're losing, and you want to be winning in the right deals. And that's why a lot of people really push this idea of diversification. And while others will push the idea of concentration, making sure that the things that you're invested in are things you understand, have influence over. But the key takeaway is no matter who you are, when you invested, what was the result, there's an opportunity that you could have a loss. And because of those people who are invested in 2021 and 2022, if you're in a position where you had capital calls or there was a chance that you were going to lose some or all of your money, it's even more critical that you then, really focus in, feel those emotions inside. What is it? What am I feeling? Am I feeling fear? How am I reacting to that? And then be able to move past that and make logical decisions. Because if you realize the rules of the game changed, then you can get in, redirect the strategy, and take advantage of the strategy that's available on the game board as it is today.
Yeah, I love it. I'm going to put a poll in here too. I want to know, we got 50 people in here. Just want to see if you feel like it's a good time to invest in multifamily now. So I just launched that. If you can go ahead and vote yes or no way. Love to know what people think. Because again, a lot of the, maybe, of course, everybody in here is interested in multifamily. Everybody says yes. But why don't you stick in the chat too why you think it's a good time to invest or why you think it's not a good time? Put it in the chat there. Love to see it. Just because I think that the rationales and the reasons we use are really important. So far, thanks for voting, guys. This is awesome. We've got 90% say yes. We got a couple no's. We got 10% no. And we'll just keep, I don't know if you can see this. Are you guys able to see it? Are you able to see this, Steven? Can you see the poll?
I can see it. I cannot vote on it because
You
I'm
cannot
I'm a
vote. He tried to
panelist.
vote 10 times as yes, yes, yes. So you're all the votes there. We'll keep that vote going for a bit and then we'll keep this going. But just put in the chat if you would, kind of why. Yeah, he says yes if the numbers work, depending on the marketing, the underwriting. I think it's really good. So we'll take a pause or just keep going on that poll and just putting some stuff in the chat, what you think about that. So how do you, I guess this is a question, Stephen, and we can kind of talk about this as well. How do you manage risk right now, right? So if a multifamily deal looks good, like what are some considerations that you make as far as the market, the operator, the just different factors that go in as far as, how do I assess the risk in this type of deal?
Yeah. Well, I'll just answer the poll. I think it's a great time to invest in multifamily. And it's not because I am a multifamily operator, although you could say the reason I'm a multifamily operator is because that's where I see the biggest opportunity. Um, that's what's nice about working with and being a nimble firm. We've got a great team working really closely with one another. It's not that difficult for us to pivot and shift to where is the biggest opportunity. Um, the reason I like multifamily and the way that I'm mitigating risk are kind of one and the same. Multifamily is a human need. People need a place to live, and there's a huge lack of housing in the United States. There's a huge lack of housing in the specific markets and metros that I personally am focused on investing in. A great example is in Denver, Colorado. I primarily focus on investing in Colorado, Denver, Colorado Springs, in between there, and in the Midwest, Des Moines, Omaha, Lincoln, Kansas City, this heartland type market. And what I noticed from a shift standpoint was that Denver is a phenomenal growth market. It's not a great cash flow market, but it's an opportunity to create really high IRRs, big equity multiples, versus the Midwest was always very good for cash flow. Now, the core thing here is, from a risk standpoint, I want to invest in markets that are not overbuilt, that there's been a lack of development that has happened at the same rate of where population growth is. And so, I'm typically buying 1960s and 1980s assets, and I focus on those in particular because, we have an in-house construction team on our platform, in-house property management, and we get construction done at 30 to 50% below a typical general contractor's cost. So I can mitigate risk, one, because I know the thing that we're the best at. We know how to do construction very well, and we can do it cheaper than most other people. Mitigate risk by buying low, right? You're buying that value. You're buying at a 20 to 30, even 40% discount to current appraised value. And then I'm buying well below what the future potential value is based on current comps in the market today. And because I'm a value add buyer, I'm not typically looking at cap rate, although cap rate does play a role. I'm more so looking at, well, what is the basis? If I can buy something at $65,000 a door that I know I can sell at 105 to 110 a door, that's a huge spread. There's a lot of room in there for profitability. And because of that, there's a lot of room for downside protection. So if I'm buying at a 20 to 30% discount and I needed to sell right away, I know I could liquidate and I could get my money back. But if I go and add value and it's things that I control and I can increase NOI, I can add other income, I can decrease expenses, all things that we're very, very good at. I know that I'm in a position of control. If the market was to go down by 20, 30%, I'm still in a profitable position. Now, so when I'm looking at risk, I'm looking at underwriting the base case, projecting on the base case, and I'm leaving a lot of upside opportunity on the cutting room floor, if you will. Things that we're going to do, but we're not going to include in the pro forma. And so the nice thing about that is if I'm underwriting something to an 18 IRR, and it's a growth focused deal, I know that realistically, if I underwrote with everything I'm going to do, I'm probably at a 25 to 30. So that gives me a lot of buffer because I'm setting a lower expectation, but I have that room to move. And then finally, in this market in particular, I'm raising more reserves than I was in the past 2 to 3 times the amount of reserves. And I'm putting on fixed rate debt. And in cases where I have a belief that selling in the next 3 years is going to be more profitable than holding for cash flow, I'm getting debt that does not have prepayment penalties, so I can have the flexibility to sell, refinance, do whatever's necessary.
Yeah, understanding the deck structure is really important, being well capitalized. We had a couple deals that really struggled from really not being well capitalized, some operator stuff, as well as not having fixed rate debt or knowing the amount of time you have. And when you're putting 20% down on any deal, it's always a higher risk position. And so these days, you mentioned a couple things. One is, I've had a lot of smart people on these panels, and one of them talk about, find out what your edge is. Where do you have an advantage over other people? And, right now we have an advantage because we're buying stuff that other people don't want. I mean, there was a time where, you remember this, Stephen, just a few years ago, we'd have 30 offers on one property, right? And it was just like, it was crazy. I mean, you had to come in above and all that. Now it's like, there are deals available if you're willing to do the work. And also, like I said earlier, in great markets, finding you can find significant discounts. I did want to talk a little bit about interest rates because there's, obviously we know short-term rates. I think they just announced they're coming down another 0.25%. And so that's great. We're seeing a drop, which is really helps out real estate investors. That's awesome. There's some speculation on long-term rates, whether rates will be lower or rates will be higher. I'm going to put this poll out. I have another poll for you guys, which I'm just enjoying sending these polls out. Let's see if I can launch this. Is this going to let me launch it? Actually, I can allow the panelists to vote. Okay, so okay, now it's being shared with the meeting. So it should be, let's see, a poll is being shared in this meeting. Can you guys see that? Are you able to see that, Steven?
I can't see it.
Okay, let me try again here and share this with you. Oh, I can't hit launch. Okay, maybe there's a, oh, actually, I got to stop sharing the old one. That was it. Okay, cool. So I was sharing the old one. Okay, here we go. So we got a new one. So what do you think, oh, wise audience, what do you think interest rates will be higher or lower in 2 years? So I'm talking about 2 years, right? Will they be lower or higher? 2 years is not just, hey, a few months. We're talking 24 months down the road. Do you think they're going to go higher long term? So there's really smart people that I think are really on both sides of that. But I just love to hear everyone's thoughts. And we've got a bunch of people voting already. I'll share these results here in a minute. And Stephen, I'd love to know your thoughts on that. What do you think?
Yeah, well, I'd love to kind of get into that. I will say one thing that I noticed in the market, going back to where's the edge, like everybody in multifamily from an operational standpoint would prefer to buy a 200 or 300 unit building or buy a large portfolio because you've got economies of scale. But I'll tell you what I noticed in 2023, in particular, late 2022, the the small mom and pop, the sub 3 to $12 million deals, which in Denver is a 20 to an 80 unit deal, and in the Midwest is a 100 to 150 unit deal. What I noticed was those mom and pop, they could not refinance. There was essentially no buyers, and if there was any type of distress from a construction standpoint, people were out. And so the key thing I would say when it comes to investing is you got to find where everyone else is not. Nobody
Hmm.
wants to go buy a 20 or 30 unit deal. It's not sexy. It doesn't look great on an offer memorandum. It takes as much effort to do that as the 100 unit deal. But the reason we were focused and we bought so many of those deals is because, we were underwriting 30 to 40 IRRs, and we
Yeah.
were underwriting them conservatively. And so it's very interesting. And that plays right into the interest rate space. Because interest rates have started to go down, what I've noticed is a lot of sellers have started to get a little bit more confident, thinking that they might be able to get their price. We'll see if that's true. My prediction is that rates are going to go lower than they are, but I do believe they're going to stabilize higher than they were in the past. A big part of what's going to play out is what does happen during the Trump administration. How does tariffs, how does reducing the size of government, increasing efficiency, reducing the debt? Because we have a major issue in this country
Hmm.
that our debt service is $1 trillion plus a year. Our
Yeah.
debt service is starting to come up on the same size as some of the entitlements. And so we're in an interesting position where unless there's major cutting, the Fed actually needs to lower rate because the cost of holding on to that debt is very, very expensive.
Yeah, and the result of this poll here, I published it. So it's 69% rates are going to be lower in 2 years from now, and 31% says rates are going to be higher. Yeah, I've heard conversations both ways. I think that yeah, it's just so funny. We look back and everything seems very obvious, but you're right. I mean, there's these macroeconomic forces, and this is where if you weren't paying attention to the macroeconomics in 2008, 2009, you would have lost your shorts, right? Even if whatever your asset was, whether it's stocks or real estate, it was like so important to pay attention to what's happening. And so we do. We have this incredible debt that is difficult to service. Now we can create more currency, but I mean, really, the more you create, they have to keep rates low. And what happens is it just becomes an inflation tax really on everybody, right? They just continue to inflate assets and inflate away the debt. I think that's kind of really interesting. So let's talk a little bit more, kind of get a little more into that. We're going to do some questions here in a few minutes. And I think this is just a great conversation to jump in and see kind of what's happening. But how are you seeing, this panel is called The Shocking Truth about the future of multifamily. Now, the shocking thing is that we don't have any technology on the horizon that people do not need a bed to sleep in or a roof over their head, right? As much all the advancements we've had, self-driving cars and people going to Mars, or we're trying to send people to Mars, nothing has come in place. We know people are going to need. So in a way, it's kind of a shocking truth that it's just boring that we have this incredible demand. What do you see kind of over the long term, the next 5, 10 years? For multifamily or just real estate in general when it comes to investing, when you look at kind of the big picture?
Well, unless there's a major change to the way that the US provides housing, right now the US government essentially uses tax incentives to incentivize investment into housing to provide the housing stock that we need. So, some things that I think we need from a country standpoint is we need to build a heck of a lot more apartments, a heck of a lot more houses. And the only way that's going to happen is if the local governments have some kind of forcing mechanism by the state or federal government to stop this NIMBYism. But the truth is, from an investment standpoint, it's very unlikely to happen. So, because there's such a lack of supply, the cost is going to only continue to go up. And so, as long as you're an owner of that, risk adjusted, inflation adjusted, multifamily and real estate in general is going to be a great place to be because we are definitely moving more into a renter's nation. A lot of people are priced out from being able to buy a house. Just one anecdote is in Denver, Colorado. The cost of housing on average in the city of Denver is right around on average like 780, almost 800. Realistically, you're at 1 million if you're not in a really bad neighborhood. And the irony is that it's about 42% cheaper to rent in Denver. I own, hundreds of millions of dollars of real estate. I rent because I pay about almost 50% less renting than I do owning because I'm professional. I'm running the numbers, and I negotiated to buy the house I'm renting. And I told the guy, like, look, you'd have to sell it to me for a deal, and it still wouldn't make sense. So I think what that's going to lead to is a lot of people are still going to want the American dream of owning a house, and all the respect. And there's a lot of great reasons outside of financial to do that. But the truth is, a lot of people are going to be forced to rent. And if you're the owner of that parcel and you're able to create a great place for people to live, you're going to be in good hands. Now, the risk is if you're in markets where you don't actually own the property, where the tenant essentially owns it because they have all of these regulations in place, rent control, tenant protections, things where they allow people to stay in units without paying and without any kind of subsidy or guarantee from the government. That puts risk. And so what it really comes down to is kind of a tale of two cities. It's a tale of the blue cities, non-political, the blue cities with the policies they have in place that are anti-landlord, and the red states that have pro-landlord. That's going to be the difference between whether multifamily is going to be a great investment. It's going to come down to the local jurisdictions that you're investing in.
I think so. It's interesting. I live in a blue state. I live in California, and we don't buy any real estate in California, or we buy in other areas because it makes more sense as an owner to buy. Now, I have a friend, Mikey Taylor. He's a professional skateboarder turned investor. Lives in the LA area as well, and he does development in the city of Thousand Oaks and kind of up north. He'll build stuff but he feels like it's so hard to build here that like that's his advantage, that's his edge, right? As he builds in an area, it's really hard to build, and then these things sell for some crazy amount of money. But obviously, I prefer cash flow because cash flow reduces your risk when you're in a deal. And but we took about a 2 year break from multifamily, and we the last 3, 4 months we've been getting in pretty hefty because I think this is a great time to get in. I think some of the things that we're seeing now, and I think this is interesting, regardless of what happens with interest rates. This happened in the late 70s, early 80s. Interest rates went up really high. I mean, up to almost 20% at one point, and they went crazy. It went up, but real estate doubled in value over that same period. It went up substantially over like a 5 year period, right? So just because rates are going up doesn't mean valuations go down, and that's sometimes people get that wrong. That like it is supply and demand as well. So again, we're not building now like we were. Some of these things that we have built, they're going to start coming online, and I just think being prepared in the market can be good.
Well, here's where
Yeah,
I'll kind of disagree.
please.
I'll agree with you and I'll disagree at the same time. I'll agree with you if that interest rates go up to 20%. the valuation of that real estate is going to go up, but people are going to start buying those assets in cash because if
Yeah.
interest rates are 20%,
Yeah. It's
then they don't
ridiculous.
need to take risk on risk capital because they're able to get a crazy high rate. What I'd say is because interest rates went up so high, so fast, right after, literally one quarter after the Fed said, we're not going to raise rates, COVID was too bad. The next quarter, they started raising rates. So, the prediction markets were way off. That's why a lot of these banks were in tough shape. That's why a lot of these operators are in tough shape. But the rates going up is the direct reason that valuations went down by 35 to 40%. And the reason is because the cost of that mortgage went up so much. So if they had to sell, a new mortgage would have to be put into place, or they'd have to put a lot more equity in. And so there is a balancing factor where it's like real estate and multifamily is going to be great long term because there's a need for it. But as long as people are dependent on getting 60, 70% loan to value loans, having rates stabilized is what's going to be important rather than it going up and down as it has.
Yeah, I agree. I think that's a great caveat. I think it's important to look at kind of the asset itself is a very stable asset. There's always going to be a need for it, and just really positioning yourself correctly is important. Let's start to take some questions now. We'll take a few questions here. There is one from earlier where it was asking about. I think I pulled it up. It was about inflation um, and immigration. So, or see about tariffs. Do you think tariffs and immigration will drive back up inflation, and what impact do you think that will have? Or is this? I mean, do you think those will have an impact on multifamily, Stephen?
It's hard for me to make a determination on that. If I was going to give a pure opinion with no real backing, I would have to say logically, a lot of immigration is going to drive up the cost of housing because there's going to be a lack of housing, especially if the government is continuing to pay these people to essentially come into our country and live off of our resources. That obviously is going to make it more expensive for everybody else who is already living there. Now, under the new administration, if they actually do close the border, start disincentivizing immigration, start disincentivizing and cutting off all of those payments, then I could see things, uh, go back to kind of a normal world. From an inflation standpoint, immigration should be deflationary because these people who are coming in should be coming in and being willing to work for a lower wage, thereby creating more unemployment, thereby lowering wages, which should have a deflationary effect because of lower cost labor. But hard to say how that's going to impact multifamily. I think those dynamics are so macro that it's hard to make investment decisions based on those things.
Yeah, I could see it. Some of these things have multiple factors too, right? So you have the deflationary of the wages going down, but it also could be that because there's more people now that need to live in apartments, and certainly like the Denver area has tens of thousands of more people in it before, and so that will drive prices higher. Or I guess there's more people live in an apartment, but then that can also be more challenging. So a lot of these things there's inflationary and deflationary factors, and again, in hindsight, they look obvious. One thing we know is that there's going to be more demand for multifamily. So what do you think? I mean, as far as advice or things that you see, obviously we're not giving any specific advice for investors, but what do you see right now as something that to pay attention to? I mean, if let's say I have $1 million to invest, do you invest it all now? Do you just put a little bit in now and over the next year or two, things are going to start to open up? I mean, there's a question of we don't necessarily want to time a market, but sometimes I've seen investors come and just like put all their money down right away, or just not in like just be almost in paralysis, right? So I guess what's a good like strategy and approach to kind of like as far as the timing where we're at right now, is it a deploy it all moment, or is it kind of like, hey, I'm just going to kind of continue to look for the right deals and get back in, and over time, over the next year or two, be fully deployed?
I think it comes down to this. If you have a very clear strategy, a very clear vision, and you have insider knowledge on how to deploy that capital, I think with that in mind, if you've got some amazing deals in front of you, sometimes you got to jump on them and you have to allocate heavily to those. I would highly recommend investing all of your eggs in one particular property. I personally see real estate playing a 30 to 60% positioning in a portfolio only getting above 40 or 50% if you have insider knowledge, you have deep experience, you really understand the asset class, and you have deep trust in those people that are operating on a day-to-day basis, or that is you and you're an expert. For most people, what I'd recommend is determining how much am I going to invest in this asset class? How much have I invested in the past? And what do I need to offset? So if I was invested $1 million in 2021, 2022 assets, I want to be investing at least $1 million, if not $2 million into 2023, 2024, 2025 assets. And I would want to make those allocations. I would want to spread those out. So if I was coming into it right now and I invested $1 million in 2021 and I had not made another investment since, I would want to deploy $2 million over the next 12 months. And I would spread that out strategically over deals that both have a high growth potential, but that is very risk adjusted, as well as cash flow deals depending on your personal situation. So my perception is that what we're going to see in the next 3 to 6 months is going to be the market moving up. That is a crystal ball moment. So I'm not going to bet on it, but that is my belief and what I personally think is going to happen. The way that I've personally been allocating money and doing deals is I'm doing the best deal that's available right now. So the best deal that was available in February of 2021 was a great deal in Denver. Was able to negotiate 3% fixed financing, 90% loan to value loan on purchase, and then bring in the CapEx money. So it blended out to about a 70%, 65% LTV loan at 3% in February of 2023. That was a phenomenal deal. That is a deal I need to hold for 5 years because the debt's 5 years and 3% debt is super, super good. Now, following 3 or 4, 6 months later, the best deal I could find was another deal in Denver, but I put on, local bank debt at 7.5%. And I was able to flip out of that property in 6 months on one of them, on 12 months on another. And I was able to create a 24% IRR on one deal, and I was able to create a 34% IRR on another. So the point is, as I look forward from this point in time, there's great deals. We just closed a deal 2, 3 weeks ago. It's not available for investment, so this is not a pitch. The deal, we bought it at $54,000 a unit. It was the lowest price per unit that's traded in Des Moines in this cycle. So in a very long time, many, many years. And that deal was bought for 16 million, and at exit it's worth almost 27 million. So the point is, there is incredible deals out there, but you do have to dig for them. The one caveat is I know what I'm looking at because this is what I do every day, and I feel very comfortable putting my name behind the deals that I'm doing. I think the difficult thing is when I look at deals other people are doing, I see some that look good and then I see some that look aggressive. And so I think it's important that you really get to know the people that you're going to partner with. You understand how they think. You look at the track record of what they've done, what kind of projections they had, and you make the decision to invest with them based on not the projection, but how much more above that projection is available. In other words, if you are trying to compare a deal that's an 18% IRR to another one that's a 19, who knows which one's better unless you're able to see underneath the hood and really be able to compare operator to operator.
Yeah, that's a really good point. I mean, I remember, when I first started, it was like, oh, this one's a 20 IRR and this one's a 17. Well, the 20 must be better, but it could be, maybe a 14 IRR is better because it's with a great operator that's more conservative, that's making better assumptions. And you just, again, there are ways to very aggressively look at things to where, well, has there been a sensitivity analysis that if cap rates go up substantially or if rates go up substantially, what does that do to your deal? Does it all fall apart? And what happens if how secure is the debt? Those are all important things. We're getting some good questions here. I want to start kind of handling some of these questions here. Emily asked a good question about cap rates. Multifamily deals seem to be done at cap rates of 4.5. I mean, I think now, I don't know, 4.5 to 6. Historically, it's not very low. A lot of these were north of 8%. So historically, we're still at a low cap rate, kind of what we're seeing. So if long-term rates increase due to deficits, I don't know if they would increase due to deficits, they would probably go down, I would think. But I guess let's just say for whatever reason they do go up. How would this impact things? I guess just more pain in multifamily, would you think? Or I guess the best deals wouldn't be around right now? Or what do you think about that if rates were to go up long term? Or do you think that's not even really a possibility because, because of the big deficits we have and we have to keep rates low?
I've learned my lesson. Anything's possible when the
No
Fed is
certainties.
involved. But what I would say is that a lot of people will look at cap rate and they'll try to make a determination on the value of a deal based on the cap rate. And now, yes, valuation is often based on NOI divided by cap rate to get to the value. But I think the important thing to understand is the difference between a stabilized deal that's built for cash flow, that doesn't have a lot of value to add, that is not a redevelopment or development deal versus a value add deal. And they're going to operate very differently. For example, I'm closing on a deal that is, 165 a door. Every comp, same condition. Every comp has sold for 95 to 110 a door. Same condition, same situation. The owner's just not operating it very well, and things are below market. So I'm buying that at like a 3% cap rate in the Midwest. But the reason it's a 3% cap rate is because it's in distress. It's a business that is not being run well. They've got way too many expenses. They're not pushing rates, market to market rates. So cap rate would be a bad way to evaluate that deal. Instead, you
Right.
want to use either the simple, price per door versus, the comparables, or I want to look at something called yield on cost, which is I'm going to take all of the cost of buying the asset and all the cost of renovation, and I'm going to divide that by the exit to be able to get that yield on cost. But to answer your question on long-term rates, I don't think personally that they're going to go up. I very well could be wrong. If they do go up, we've baked that into our underwriting. But if they go up by more than 1% from where they were 3 months ago, then most people who are buying deals today are going to be over their skis. That doesn't mean that the deal doesn't still work because you have to have those risk mitigation pieces that I was talking about: below market purchase, add value, control expenses, operate very well. All of those things will put you in a position to weather the storm and wait for the market to stabilize. What do you think, Bronson?
Yeah, I think we're talking about an asset that is in demand and it will continue to be in demand. I think that as long as your debt is stable and as long as you have a good plan, if you're adding value or whatever process you're going about, what is the certainty? If rates do go high, are you able to weather that? I think the challenge when we get in trouble is a lot of times it's the debt. We don't have the debt in place so that if either rates are not attractive, valuations aren't attractive, you don't have to sell when you don't want to sell. We're buying deals now where, are discounted 20, 30% of where they were at the peak a few years ago because people have to sell. They literally have no other option. They have to bring $6 or $7 million to a 30, $40 million deal. But so they're actually losing money, right? So they're losing investor equity, and it just comes from being in a position where they have to their debt is not set up for them to be able to make it work. So that's a tough situation. So if you can have the more flexibility you can have, the better. I think that all the options looking on the front end and saying what happens if this happens, if rates went to 10%, would you be able to weather? What would that look like? Of course, that'd be a pretty tough situation, but would you be able to make it work? I mean, I think that's something to consider. And just to, what sort of timeline, the longer the timeline, obviously, the better. I wanted to ask too, Stephen, we got time for a few more questions here. Deb is asking as an active investor, and I think there's an element here that's interesting for passive investors as well. So maybe you can touch on kind of both elements, but particularly for an active investor, how would you, if someone wants to get into this business, wants to be an operator, you mentioned kind of looking at some of the smaller stuff that's under 100 units or maybe 10 to 30 units. Is it better for someone to buy in their own market? What are some of the tips that you kind of have seen that have been effective for people that are trying to get started? Or would you say, go bigger and go buy bigger stuff?
Well, I would say if you're trying to be an active operator, you need to be in the market that you operate to at least get started and learn this business. Traveling across the country is very doable. I do it. I'm going to Omaha tomorrow. I'll be on a flight, and that's just part of the game. But the difference is, you either have to have your own people on the ground or you have to be on the ground. And so when you're getting started, it's easier for you to learn the things you need to learn, because there's a lot that you just don't know. when it comes to your question specifically, Deb, on buy box and you live in Dallas and you like that it's a growth market, but you're interested in the Midwest, St. Louis, et cetera, you know, what's going to be better? The truth is, Dallas has a lot more growth to happen, but Dallas is a market that is extremely hit hard by the rate hike cycle. They, in Texas in particular, a state that was always considered a red state, had some very, very blue renter focused eviction laws, and it made it very difficult for people in Dallas and Houston and many of the other markets to be able to get people who are not paying out. So there's a lot of distress in that market. And prices had gone up very, very high, and they are much, much depressed now. So that can either be a good or a bad thing. The benefit of the Midwest is a stable market. When during good times it goes up by 2 or 3%, during bad times it stabilizes. It doesn't really see major declines versus the Southeast, Phoenix, Vegas. These markets see huge swings. So it depends on what you're looking for. The reason I like the Midwest is because it's very unsophisticated. There are very few people who do what I do at the level that we are able to do it that operate in the Midwest. Yes, there are some great players out there, but they're not institutions. Now, more institutions are moving in the Midwest, but that would be the argument pro Midwest. Now, if you live in Dallas and you're trying to get in the game, it's easier to get in the game in your backyard because you can go drive to the property, you can meet with the brokers, you don't have to fly all over the country. And most importantly, on a day-to-day basis, you can be present to see what's happening. Now, I have the luxury of my partner has a 50-person staff on construction and property management based out of Des Moines. And so it's a 90-minute drive for them to get down to Omaha. And we have a bunch of team that's down in Omaha. And so that's right in our backyard. It's easy for us to do because we have the right people in place. So keep that in mind if you're going to go and try to do this yourself.
Yeah, no, I think it's something definitely to consider. I mean, that's one of the reasons why people are passive investors is that they, don't have to deal with all the stuff. And, really it is an insider's game. So I think that the more you're in this, the more you realize, like, if you own stuff in a certain market or we own stuff in a certain market, we're going to get stuff. People are coming to us first. They're like, hey, we've got this deal we want to offer to you because you bought the one down the street. And it's amazing when you're at the beginning, you're chasing the brokers, and after a while, they're all chasing you to buy their stuff. So it's kind of funny how that works. I guess when it comes to vetting, I guess we have time for maybe this one or two more questions, but when it comes to vetting an operator, so particularly as a passive investor, what do you say are some of the questions that people should be asking? What are the things you should look at when you're vetting an operator, Stephen?
Yeah, I think when it comes down to vetting an operator, what's really important is that you have an opportunity to really spend some time talking with the team. So first things first, I want to be able to have a conversation with the team. That doesn't mean you're talking directly to the CEO or the head of the company on that first, second, or third call, and maybe not even at all, if depending on the size of the company. With that said, the things I want to understand is I want to understand the culture. I want to understand how do they think and believe in alignment. Like an example is at my company, everybody from the leasing agent to the construction manager to the international team that's handling administration to the IR team who is, servicing the conversations and helping to support you to myself and everyone else in between, construction, property management, everybody's got a piece of the deal, meaning everyone's got alignment. So the benefit of that alignment is that the construction manager knows that when he saves $1, it's worth 5. The leasing manager knows when he can go and close an extra dollar on a lease, it's worth 5. So because it's worth money to them personally. So you get this owner mindset. So I want to know, how do they think about alignment? And that's really important. Alignment both internally and with you as the investor. I want to know their track record. I want to know what they've done, how they've done it. I want to know where they've messed up, what they've learned from those mistakes. Losses are not the end of the world. Actually, most of the time, people learn the most from a loss. For example, when I was flipping houses, I flipped 200 houses. I had a loss. I wrote a check for, 40, almost $50,000 to pay off the investors and make sure they were made whole and made their interest. But I took that and it hurt. But I learned a lot from that and it changed the way that we operate. I also want to know from that track record, are they running the same strategy and program that they're running in the track record versus what they're doing today? How is the strategy different? What were they projecting? What were the results? And so what I'm really looking for is I'm trying to understand, how do they think about this game of investing? Are they staying in their lane? I'm totally cool for somebody to go out and do something slightly different, but you have to know there's more risk associated with that different thing until they build that track record. So, and then I want to make sure it's a cultural fit. Like, one of the things I've noticed, with many of the investors who are writing million or 10 million or $100,000 checks with our firm, when I talk to them, one of the things that they're attracted to is the culture of the firm, how we think, the mindset of it, this idea of like creating value for everybody around. You create value when you make your investment in the project. That's what allows us to go and be able to run the business. We create value by executing. We create value in the community where people live. We create value by employing all these people. And it's this cycle. So not everyone thinks about it the same, and not everyone's going to like that. So you want to make sure that culturally you're aligned. And then finally, from a strategy standpoint, even if you're not an operator, even if you're not a real estate professional, you want to at least be able to logically understand, what is the way that these guys are going to go out and make money? And does that logically make sense? Because even if you don't have the ability to go vet the comps yourself and walk the property and do all the due diligence that we do as operators, you want to know that, do I trust that they're going to do what they say they're going to do? And do I trust that when there's a problem, and inevitably there will be a problem, that they have the smarts, experience to be able to solve that quickly? Because the most important thing to understand about investing, especially in real estate, but across all businesses, asset classes, et cetera, is that investing is simple, but it's not easy. Like, this game, it takes a lot of work, and you learn the lessons and you get beat up. But at the end of the day, these returns just don't miraculously pop out of thin air. Like, they are created, they are cultivated, they are shepherded. And so that means sometimes things won't go right, but the best operators in the business will be able to communicate transparently, where are those problems, how are they solving them, and they'll be able to show you confidently that they can do that.
Awesome, Stephen. Great. You got a very polished way of speaking, man. You've done a lot of this. Appreciate you. Before we wrap up here, I just wanted to kind of add to that a little bit. I think a lot of you, just so much gold you just shared there. And I think the biggest thing I find is, are the values aligned, right? I used to think everybody wanted to have the same goals. We all wanted to, do great deals and communicate well with investors. And a lot of people want to raise money and they never want to talk to investors again. And it's just kind of a weird thing to me, but because I'm such a relational person. And so the performance and the communication are very important as well. So anyway, I hope you really enjoyed this event. I'm going to share a couple things in the chat here. If you haven't checked out, I'm going to give Stephen give a way to reach out to him as well. So Stephen, put your information in the chat as well. If you haven't checked out my book right behind me here, it's become an Amazon bestseller, over 800 reviews now on Amazon. 4.7 stars. I'd love to have you check that out. If you haven't joined our investment club, we have deals inside real estate, outside of real estate, and we're not able to share them publicly. And so we've got one right. We can't even really talk about it because of just the type of deal it is. I may have to actually put that as a link here. But Stephen, why don't you give people how people can reach out to you, how they can connect with you, hear about your deals, your podcast, the stuff that you're working on, brother.
Yeah, so I started a podcast called the Investor Mindset Show back in 2019, early days. Um, a couple million views, been a really fun show. I've been able to have a lot of great conversations. You can find the archive and active episodes there. You can, of course, follow me on social at Steven.Pesavento. But I think the best way to get in contact with me and with the team is by going to vonfinch.com. Go to vonfinch.com, opt in, share a little bit about yourself, set up some time with Jed Cooper or Eric or any of the folks on the investor relations side, and get a chance to get to know us. Share a little bit about yourself. What are your goals? What are you looking for? The kind of things we like to talk about is we're going to want to get to know you, because not everyone that we talk to is going to be a fit. And if you are a fit and culturally it seems like it's good, we're happy to kind of invite you inside and kind of show you what we're doing. And we've got, some incredible things from 10% fixed income debt fund. We've got amazing growth deals that are targeting above a 20 IRR. We've got some amazing deals that are targeting, 6 to 8% cash flow and, a nice back end appreciation. we've got great things, and they're all multifamily. And we've been doing it a long time, and we'd love to invite some more people to come and play the game of investing with us.
Awesome. Thanks, brother. Well, appreciate you being here, man. I always learn something when I talk with you. I always appreciate your approach, your personal development approach as well. So check out Steven's stuff. Great guy. Appreciate everybody being here. We look forward to next month, actually December 17th. We're going to have a tax strategy panel with several CPAs, tax strategists. It's going to be awesome. So I don't have the link for it yet. I'm just going to put it down. It's going to be this time, December 17th at 4 p.m. PST. So mark your calendars there. It's going to be awesome. Appreciate everyone. Thank you for being here. Thank you for taking the time. We will send out the replay when this is over, and we'll look forward to seeing everybody in the next show. But thank you so much. Thank you, Steven, again, and thank you to everyone.
Cool. Thanks, guys.
Bye, guys.